Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. The market has thrown out a lot of stocks, including a lot of companies that both generate cash and have a lot of cash on their balance sheet. So I wanted to highlight some of the companies that have a ton of cash on their balance sheet that they can deploy in a number of different ways. It's not only protection for the downside if we go through a rough patch with the economy. They can buy competitors. They can return it to shareholders. So the saying is cash is king, and I think that's true from an investment perspective. To talk about this, I brought on Jon Quast, creator of Working Capital. Tell us what you're doing at your YouTube channel, Jon.
Travis, over at my channel, it's all about personal finance. So I do try to talk about more things than just stocks. I branching into real estate and personal finance as well, but it's all about learning stuff and taking action.
There's really great content over there, and I'll put a link to Jon's channel in the show notes below. But today we're talking about a topic that I know Jon loves, which is companies that have a ton of cash. This is one thing that I will get a message from Jon. Did you see this company has 100% of its market cap in cash? We have 6 stocks today that we're going to talk about. Jon, what is the first one that you want to cover that is a cash king?
So this is a company that I believe most people know and love, and that is Zoom Video Communications. Right now, as of this recording, about a $20 billion market cap. However, they have over $5 billion in cash. Now, keep in mind that this is a profitable company. And why is it that the market has sent its stock down so far that now more than 25% of its market cap is in? Basically, people think that now that the pandemic is coming to an end, that Zoom's relevance is also coming to an end. Really, that couldn't be further from the truth. If you look at Zoom's numbers, they're really retaining a lot of their business. They are losing some consumers like you and me, Travis. However, the enterprise clients, the businesses, they are sticking with Zoom. They may not be growing as fast as they once were. However, I think that it's a really reasonable price when you consider that they are still retaining their customers. They are still growing. They have options to grow from here. If you recall, they tried to purchase a contact center business. It was blocked. So they went in and built their own contact center business, and it's growing by leaps and bounds. Over $5 billion in cash, I think this is a compelling valuation for this stock right now.
Yeah, and like you mentioned, this is one of the companies, I think, in the tech space where there's going to be a lot of businesses, both that are in public markets right now, but also in the startup world, they're going to be hurting for cash over the next 12 to 24 months. We're going to be looking for an alternative. What do? We got to sell maybe to somebody. Zoom is a great buyer, and the more that they can integrate, the more that they can have a fuller solution, suite of solutions for businesses and individuals. So I love that one. The one I wanted to highlight next is a company that went through a lot over the last year. That is Zillow. They got out of the iBuying business, which it turned out wasn't profitable and was probably really poorly timed because they got into it just as house prices were going through the roof and then maybe starting to crash. They think they got out pretty much unscathed as far as from a financial perspective goes, but that was a big black eye for them and they lost a lot of valuation as a result. But as we're recording, stock has a $9.9 billion market cap, and they have $1.8 billion in net cash on the balance sheet. That, like we touched on earlier, is not only protection for the downside. If we go through a little bit of a rough patch here in their advertising business, which is where they make most of their money through the Zillow app, but they could go out and buy some competitors. They could potentially buy stock or return cash to shareholders. I think there are a lot of different things that Zillow could do. And when you're a company like this that has cash, has an established business, and has a low market cap, investors are just looking for you to show that you're doing something productive with that money. So now that they're out of iBuying and that sort of question mark is behind them, I think in the future, we're going to see the company be a lot more productive with the capital that they have. So that's one that I am definitely, I think, a little more bullish on than I was a few months ago, given where their balance sheet is at. What's up next for you, Jon?
Next up for me is a company called Udemy, symbol UDMY. This is a company that not a lot of people know. It went public here in the last couple of years. Basically, this is a company that takes away all friction when it comes to online learning. So anyone can create any course about anything in almost any language that can be watched almost by anyone, anywhere. The friction is gone. And what I really like about that is it allows a lot of content to be made. Not all of it is great, but some of it is really good. And Udemy, what they've done is they've started to curate their content. And so people come to Udemy looking for information. They pay for access to a course. And over time, Udemy has started learning which ones are the good courses and which one are the bad. And now they've started to package these better courses into a subscription product for businesses. So any company out there, be it Microsoft or Coca-Cola or whatever, want to give their employees skills, but not necessarily a certification or a degree, they can subscribe to Udemy Business and get access to the whole catalog of courses that are curated by Udemy. And this is becoming a very big growing part of the business. Udemy Business is higher margin for the company, and it's also faster growing than the overall business. And I really like that going forward. The founder and CEO did just step down from the company, but they promoted the president of Udemy Business to take over the whole thing. So I think that has some good continuity there for what is working for the company. You look, it's roughly a $1.6 billion market cap and almost $500 million in cash. So about 30% cash right now. I really like this company going forward. It has executed well since going public.
Yeah, that's an interesting one that probably needs to get more attention from investors. The one I want to go with is GoPro. This is a company that is probably a really well-known name, but has been in the basement as far as investments go for, 6-7 years now. You might remember that they came to the market. There was a lot of hype about becoming a media company and adding drones and all kinds of other stuff. It turns out GoPro is just a company that makes GoPros, and that's okay. You can be a very good company by having a small niche and being very profitable at that. And I think what the company and management has learned over time is that's what the core business is. As a result, $208 million in net cash on the balance sheet. They are generating cash at this point. We'll see what happened with 2022 after the fourth quarter. That's always a really big quarter for them. But an $862 million market cap, meaning about 24% of that market cap is in cash. Here's another company where maybe the right answer isn't to buy another competitor. It's just to start returning cash to shareholders. Maybe you start buying back stock. Maybe you start paying a modest dividend. They could even maybe pay a 5% dividend yield. I think that could make this a really good investment. I think one of the underappreciated parts of the market right now is these companies that they just need to be what they are. Not every company needs to be a $1 trillion company or have the pathway to become a $1 trillion company. You can be a really good investment and just make action cameras and sell them to your niche market. That's what GoPro has learned to do over time. And I think I like the cash position and I like what management has learned. What's the next up for you, Jon?
Next up for me is restaurant technology company Olo, symbol OLO. This is a company that I have watched for a very long time. It came out of the IPO gates very hot, ran up to, I believe, $40 per share. I thought it was pretty overvalued at that price. We're recently coming down to just around $6 per share. And if you look at the market cap, currently about $1.1 billion, and they have roughly $468 million in cash. So again, one of these companies with a lot of cash on the balance sheet. What I like about Olo, you look at what has happened with the restaurant industry, DoorDash, Uber, all of these companies vying for third-party delivery. Restaurants don't really like that. It's not great for their business. They don't control the data when it comes in through these third parties. It's not particularly profitable for them because they're paying such a high commission fee to these third-party aggregators. Olo is a technology service that keeps everything in-house and puts the restaurants back in charge and helps restore some of these profit margins for the restaurants. So it is seen as a better option for restaurants. Still allows third-party delivery. It's just a matter of who's in control. Olo really does have first mover advantage in the space as well. It has been doing this for a long time, and you look at the customers that Olo has. It is a who's who of restaurants. Virtually any restaurant chain of any size is using Olo to some degree. Now, the company has 12 modules, so it is a software as a service business. It has one core software, but it has 12 different things that could be added on altogether. And most of its restaurant partners or restaurant customers are only using about 3 Olo options as of right now, but there are 12 available. So they're kind of getting their foot in the door by making restaurants feel good about being in control again when it comes to delivery. And then from there, they're able to grow their business by upselling to customers with all the other modules they have available. Most of the time, restaurants already have this technology that they're using, but it's from other providers and it doesn't always work together. So it makes a lot of sense to upgrade with Olo's options to have everything all on one platform. So that's one of the reasons I like Olo. I also like that sitting on the board of directors is Danny Meyer. He's the author of the best-selling book, Setting the Table. He is the founder of Shake Shack and Union Hospitality Group in New York City. This is a guy who knows restaurants very, very well and is intimately aware of what restaurant operators care about. So he's sitting right there informing CEO and founder Noah Glass on how Olo needs to be positioning itself. I think it really sets it up to win a lot of money to endure this kind of slowdown in the restaurant business right now, but I think it's very well positioned.
This is one that I had not heard about until you brought it up. So I got to do some digging on Olo because I do think the restaurant business is a really hard business, and some of these delivery companies like you're talking about, not only are they not making money, but they're making it really hard for a lot of the restaurants to make money. So maybe a technology company like this that kind of just sits and does a niche. They know what they do it well, they can scale it, but isn't trying to take over the entire space is a really good place to be. The final company that I want to talk about is Rivian. This is a automaker, but they have $12 billion in net cash on the balance sheet and a $15.3 billion market cap. That's 78% of its market cap in cash. Now, the caveat here is they're losing a ton of money ramping their operations currently. They are also investing about $5 billion in a new plant in Georgia. So there is going to be a drawdown in that cash. But if you're looking at a company like Rivian and looking for a little bit of safety, am I paying too much for this stock? I believe in the company, but I want to make sure I'm not paying an absurd multiple. Well, you're getting it for about the cash that's on the balance sheet. So if management can invest this cash with a reasonable return on invested capital, which I think they can in the EV space, the companies that have been successful like Tesla have shown that you can generate higher margins making electric vehicles, higher free cash flow, better return on investment. So I think this is a potentially really interesting company in electric vehicles. I will link to a couple of the other videos that John and I have done discussing this in a little bit more depth, but just the cash that they have on the balance sheet at least makes this a compelling one to look at. What stocks are on your radar? Because I think we have discussed a couple of interesting ones that maybe you haven't heard of here, but I'd love to hear your thoughts below in the comments section. Follow Rive Investing and, of course, John's channel, Working Capital JQ. Thanks for watching, and we'll see you here next time.